Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, if you're an entrepreneur, you know those early years are, well, they're a whirlwind. It's all about survival, right? But what about the paperwork from that chaos? Today, we're tackling a question that gives a lot of business owners some serious anxiety. How far back can the IRS really go in a tax audit? Let's get into it. And this is a question we hear all the time. In the beginning, you're not obsessing over perfect bookkeeping. You're just trying to make payroll, find that next client, and keep the lights on. So of course, once your business is finally on solid ground, it's totally normal to look back and think, oh man, what if they ask about year one? It's a huge concern, and today, you're going to get a clear answer. So here's our game plan. First, we're going to hit you with the single most important number you need to know, the basic time limit. Then we'll dive into the really crucial exceptions that can change the whole game. After that, we'll talk about what an audit is actually for, because it's probably not what you think. And finally, we'll wrap it all up with some real, actionable steps you can take to be ready for anything. All right, let's get right to the good stuff, the main rule. For most of you, this is the number that should bring some immediate peace of mind. 3 years. That's it. For the vast majority of people, that's the magic number. The IRS generally has a 3-year window from the day you file your taxes to come back and ask questions. And this isn't just some casual guideline. It's a hard and fast legal timeframe. It's called the Statute of Limitations. So this fancy legal term, Statute of Limitations, just think of it like a countdown clock. The moment you file your return, that clock starts ticking. And once it hits 0 for a specific tax year, the IRS generally can't come back and assess more tax on you. Their window of opportunity is closed. Let's make this super concrete so it really sticks. Say we're talking about your 2022 taxes. You file them right on the deadline, April 15th, 2023. Okay, the second you do that, boom, the 3-year clock starts. That means the audit window for that 2022 return slams shut on April 15th, 2026. After that date, you're pretty much in the clear. Now, here's a little insider info for you. While the law gives the IRS 3 full years, they usually act way faster. The truth is, most audits get kicked off within the first year after you file. So what does that mean for you? It means the chances of getting audited for a particular year go down a lot as more time passes. Okay, we've got the 3-year rule down, but, and this is a really big but, we absolutely have to talk about the exceptions. These are the situations where that 3-year window can get stretched a lot longer. And this slide really lays it out, doesn't it? On one hand, you have the standard 3 years, but on the other hand, certain things can push that timeline to 6 years. Or in the most serious cases, it can last forever. Yep, no time limit at all. So how on earth does that clock run forever? Well, it boils down to 3 major no-nos. Number 1, filing a fraudulent return where you're actively trying to deceive the IRS. Number 2, any kind of deliberate tax evasion. And number 3, and you really need to hear this one, is if you just don't file a tax return at all. In those cases, there's no statute of limitations. Okay, everybody lean in for this part, because it might be the most important thing you hear today. That 3-year countdown clock, it only starts after you file. If you never file a return for a year, that clock never even begins to tick. The IRS could, in theory, come knocking a decade from now asking about it. This is exactly why you'll always hear accountants say to file a return even if you made $0. Filing is what starts your 3-year protection period. All right, we've been through the rules and some of the heavy exceptions, but let's take a breath and shift gears for a minute. Let's talk about what an audit actually is, because understanding its real purpose can take a lot of the fear out of the equation. This quote right here gets to the absolute heart of it. Let me be clear. Unless you've been intentionally fraudulent, an audit is not a criminal investigation. It's an administrative process. Think of it less like a courtroom drama and more like a detailed review to make sure the numbers add up. So what is an auditor actually trying to do? Their main job is just to check the accuracy of what you reported. They're looking for honest mistakes, and if they find them, their job is to calculate the correct amount of tax plus any interest or penalties. Yes, they are trained to spot fraud, but that is absolutely not the goal of the vast, vast majority of audits. So how does the IRS decide if a case is just a simple mistake or something more serious? Well, they kind of have a checklist. First, they look at intent. Was this an honest oops, or did you do it on purpose? Second, the amount. Are we talking about a couple $100 or a couple 100,000? And finally, the impact. Is this error related to something the IRS is really cracking down on, like hidden foreign bank accounts? It's only when a case hits red flags on all these points that it even begins to move towards serious trouble. Okay, last section. Let's talk about you, because understanding the rules is one thing, but knowing how to handle the process is what really puts you back in control. Here's a powerful term you need to know: reasonable cause. See, the system knows that people make honest mistakes. If you can demonstrate that you genuinely tried to do the right thing, that you acted with ordinary business care, the IRS actually has the power to waive penalties. It's basically the tax code's way of saying, hey, we get it, nobody's perfect. So, if you do get that dreaded letter, how long is this whole thing going to drag on? Well, there's no one-size-fits-all answer. It really depends on how complex your finances are, how many things they're looking at, and this is a big one, how cooperative you are. And honestly, the agent's own schedule and experience can play a huge part too. This just goes to show how much the individual agent can change your whole experience. Check out this story from our sources. A company got audited 2 years back to back. The first year, Agent A came in, looked at the books, and closed the case in a few months. No changes, no problems. The very next year, a different agent, Agent B, gets assigned to the audit. Same company, basically the same financials, and this time the process gets dragged all the way to an appeal. It's a perfect example. Same company, 2 different agents, 2 totally different worlds. And that story brings us to what is probably the single best piece of advice anyone can give you about an audit. Be cooperative. Your goal is to get this thing resolved as smoothly and professionally as possible. Picking a fight with the person who has your case file in their hands, well, that's just not a winning move. So we end up right back where we started. After everything we've talked about, the 3-year rule, the scary exceptions for fraud, and how important it is to be prepared, are you finally ready to shred those dusty old records from your company's startup days? I think the final answer really comes down to one simple question. How confident are you that there are no major skeletons hiding in those old files? And that is a question only you can answer. Thanks for sticking with us on this one.